All right, guys, let's get this presentation started. This is a recording of what was a live presentation back on July 22nd. That's something we provide exclusively to our clients. They get it a little bit earlier than you might be viewing this if you're viewing this on YouTube or experiencing it on Twitter. But this is a live presentation. We do market insights every quarter for our clients, and this is something you get to experience too. For this quarter, we're just talking about pandemics, panics, protests, politics, and portfolios, and the need to stay actively or adaptively managed going forward. Presenting today, my name is David Zarling. I'm a chartered market technician. I'm also a partner and head of investment strategy research at Client First Tax and Wealth Advisors. We run the Adaptiv System for our clients. It's a system that's meant to adapt it to different market conditions. As always, this presentation is for informational and educational purposes only, and definitely should not be relied upon as a basis for investment decisions. We are aware of what our clients and their needs and what's in their best interest for those listening. We're not aware of those things for you. Those are things that you'd have to reach out for us and establish that type of relationship. If you're looking for any type of legal restrictions in terms of use, you can follow that link that's listed here in the video. But why don't we jump in and get started? Our agenda for this video is we're going to look at the crash and recovery that took place in the first 2 quarters of this year. Definitely market history made. We're going to look at the math problem with buy and hold investing. We're also going to look at how Adaptiv System navigates these different markets in a real world environment. And then we're going to have a Q&A panel discussion that involves Ian McMillan and myself, and Paul Zarling is going to moderate. Then we'll have some housekeeping and final thoughts. So with that, I always like to start with a little bit of story here. This is end of April. My daughter on the left here had to go to the hospital. COVID restrictions were in place. She had hurt herself, and they only allowed one parent in with the hospital. And my wife, being the expert that she is, she was allowed, it was best interest for her to go in with Lydia because she has expertise in the medical field. And this is just a snapshot from Lydia on the phone. Let me know she's okay. It was a little bit of a traumatic experience, what happened, and we'll get into that later in the video. But what I wanted to highlight here is on the same day that this event happened, which was something that was terrible for her. This was something that was not fun. She had to get stitches, and at the end of the day, by the time I came back home, because when the event happened, I did help get her to the hospital, but then based on circumstances, I did get back to my day job. But by the time I got home, that's a Nature Valley granola bar, which my daughter knows that I love. She had one to eat, and then she left one for me, and that note. And I think that's a really important concept, is how do we respond to difficulties in life? And that also applies to markets. When there are difficult markets, when there are market corrections, how does your investment process work? And we're gonna jump into that today. So first things first, I want to cover the first quarter of 2020, which was definitely one for the record books. It's one of the most historic market events that we've seen in the past over 100 years. To highlight that, when we look at the February and March 2020 sell-off, it was the fastest 30% drawdown in history. What I mean by that is from the high point in price to the low point in price, which was actually 35% from height to depth. If we look at, for example, the S&P 500, that happened in about 22 days. That's faster than even what happened in 1934. And in 1934, that wasn't even a high. If you remember, 1929 was the high. The initial crash that took place then was 31 days. This was 22 trading days, 23 trading days in February 19th being the start of it. Very fast drawdown. For context, I like to provide context to people. If you remember the correction that took place at the end of 2018, this period here, October to December, if clients remember, we started protecting client accounts. We started trimming in October. We started protecting aggressively, even for some accounts going short in December. This was about a 20% correction, and that took about 3 months. And it was a rapid rebound. Not the fastest on record, but not every correction takes place like that. Some corrections take place over 18 months, maybe even 3 years. This was 20% that took place in 3 months. 20% equivalent over here was more like 8 trading days. The market had dropped 20% in 8 trading days. From top to bottom was actually 35%. And to give you in a different visual, the 2018 20% correction was about 65 trading days. Here we are at about 14 trading days to reach 20% in 2020. So that gives you the veracity and the quickness with which that correction took place back in February and March. Comparing it to other bear markets that have taken place, that was a pretty significant move. Definitely an outlier when we look at all the different corrections that have taken place in the history of the S&P 500, going back to 1927. The 2020 correction is one for the record books. That is definitely something that we're going to write financial books about, maybe even societal books about, depending on how we view COVID in the future. This is the chart of the S&P 500, which many of you are very familiar with. This was minus 23 trading days, in 23 trading days, minus 35% S&P 500. That's a very fast move, as I've already highlighted. Our most aggressive clients in an ultra growth model, minus 18 during that period of time. In the growth model, minus 14%, and adaptive moderate, which is another model we run, minus 11%. So that gives you the type of idea of type of cushion that we were able to generate during such a strong move in a down market. You know, and I put this chart over here on the left because this is really what I'm talking about with buy and hold investing. Buy and hold investing makes two very big assumptions. One, that you will continue to hold on no matter what, and two, that the market will always come back. And that's not always the case. Sometimes people liquidate at the exactly wrong time, so that means people don't actually hold on, and not every market returns to where it came from. There's plenty of examples from history of stock markets that have not returned to where they were and have actually gone to zero. So that's the reason why we use Adaptiv. You can see here the different percentage drawdowns and what it takes to get back to even. For example, a 35% move down in stocks requires a 54% return. A 50% drawdown in a market requires, or an account requires 100% return. And so that's why we use the Adaptiv System. So we were dealing with a 35% move down in 23 trading days, pretty significant move. If you look at something like the Russell 2000, it was actually 43% drawdown. So now you have to get more than 60%, close to 70% to get back to even. That's a pretty significant hole to put yourself in if you're holding small cap stocks. Even aggregate bonds were supposed to be one of the safest places on the earth, which is just the entire bond complex represented here. That was a minus 11% in 9 trading days. Capitulation type selling, that gives you an idea of just how severe, basically anything that anybody could get their hands on, they were selling it, whether it was stocks, bonds, or commodities. Pretty traumatic. The experts didn't have it right either. For example, Ray Dalio, a tremendous asset manager, he was saying near the tops in February that cash was trash. Bill Ackman, another fund manager, or asset manager, he was saying hell is coming when we were at the lows in March. So it's very hard to watch TV. It's very hard to listen to quote-unquote experts and get an idea of the market's next move. We don't focus on predicting here at Client First using the Adaptiv System. We focused on planning. Giving you another example of what it looked like, the correction, minus 35%. You can see other corrections that have taken place in the past, whether it's from the 60s or the 90s or 1980s, how long these corrections to a plus 20% drawdown took. Here's comparison of the major moves in the past. We got the 1987 crash, 1929 crash, and again, the 2020 crash. There's no other way to define it. It was a panic crash. That was about 23 days. Pretty impressive, the most impressive panic crash or correction we've had on record. To give you an idea of the volatility taking place, here's the average daily percentage change by month from 1928 through now. In March, the average daily percentage move was 4.8%. So on a daily basis, the market was almost moving 5%, whether it was up or down. Tremendous, tremendous volatility. Even 1987 was more around 3.5%. 1929 was closer to 4%. Here we are closer to 5%. Again, tremendous, tremendous volatility. Here we are looking at total return volatility and looking at the VIX, which is a measurement of implied volatility. And here you can see these massive spikes in volatility. Black Monday from 1987, whether we're looking at late fall or early fall, October 08, with the great financial crisis, or the great crash of 1929, we had implied volatility volatility that was just tremendous during the COVID crash earlier this year. We're on track for one of the most volatile years in stock market history, and going back a few trading days, this is from macro charts. We can see that 2020 is tied for sixth for the most volatile year ever. We'll see if we remain that way for the remainder of the year. VIX for itself, implied volatility remains high, so we'll see where we end up as the year closes out. To give you an idea of what kind of damage was done during the correction, this is the S&P 500. We can see that 3 years of gains were wiped out in those 23 days. Pretty significant. Dow Jones, same thing, 3 years, basically taking the market back to where we were during the election at the end of 2016. Russell 2000 took us back 7 years, all the way back to 2013. So that's dramatic. Imagine having an account wiped out 7 years worth of gains. All World Index, 4 years of gains wiped out in 23 days. If we look at total stocks, the entire world of stocks, and we subtract out the US, basically 10 years of gains. We're at the same level we were 10 years ago in 2010. Pretty impressive correction. Corporate bonds, same thing, about 10 years of gains wiped out in 23 days. Significant selling. 20 years of gains. When we look at oil, in fact, oil futures traded negative, and that's the first time ever in history. So 20 years of gains. Oil was the same price it was back in the early 2000s or late 90s. So there's a math problem with buy and hold investing, and that's why we use the adaptive system. You can buy and hold through those periods, and that's fine, but it's not guaranteed that the market's ever going to come back. And so when we look at these bigger corrections that take place through time or quickly, as in this case, 23 days, it does take quite a bit of return just to get back to even. And so as we like to talk about, right, we don't need a parachute. We need a parachute to go skydiving, but we need it even more so we can go skydiving again. Same thing, our adaptive management is to keep that account from experiencing extreme drawdowns, which can be a negative event for your retirement planning. As an example of this, we can look at the 2000 to 2013 period, which was basically flat. Looking at the S&P 500, a $500,000 account went nowhere but heartburn for 13 years. You can see these drawdowns, a 46% drawdown, 57% drawdown. Gives you an idea of where a $500,000 account would end up. You can do the math based on your own numbers. But, losing 57% in an account just to get back to even, assuming you're holding on, takes 132% return. This correction was about 18 months heading into the first part of 2019 and took over 3 years to return just to even. This protracted bear market in the early 2000s was about 3 years, taking almost 4 or 5 years to get back to even. These type of market conditions aren't always all the time, but we don't know when they're going to happen. As I tell people all the time, maybe if we're blessed, we can pick where we live when we retire. We just don't get to pick our market. And so that's something important to remember, and that's why we use the adaptive system, is to prevent from these massive drawdowns. While this might be great to experience with dollar cost averaging in your 20s and 30s, not such a great thing to experience a 13-year period or a 50% drawdown when you're near or in retirement. Same thing during this period of time, 35% drawdown, took your account down to 325. If you have a $500,000 account, just for illustrative purposes, would take a 53% return just to get back to even. So as we tell people all the time, not all market environments are the same, right? It's very similar to driving. Sometimes you're on the highway, you can set the cruise control on the 70 miles per hour, but sometimes you're in the mountains and there's inclement weather and you shouldn't be driving 70 miles an hour. You probably should have the cruise control off. You're probably going to be braking and shifting closer more to 25 miles an hour. So that's adapting to the road conditions, just like we adapt to market conditions. Here's an example, all world index. The reason why we like to look at this is it represents a quite significant amount of stocks across the globe. I believe it's between 8,000 and 9,000 constituents, which means that's how many stocks are in it. And this gives you a really good idea. Look at the different market environments. You would agree with me that this market environment over here on the left-hand side is definitely different than this market environment from 2018 onward. Nice trending market and nothing but mountain driving thereafter. I like to highlight, well then, how does Adaptiv perform in these different market environments? How does it perform in a nice market where we can put the cruise control on? 2017 was an example of that. Total world index was up about 24%. S&P 500 as well, just a little bit less than that. Adaptive growth was up 23%. These are all net of fees. During this period of here that began basically after this blow-off top in January 2018, this is a sideways period with heartache, right? The market goes nowhere all the way till October 2019. From January, February 2018, 0% return for the market. In addition, there is a 19% drawdown. During this same period of time, how did adaptive growth do? Adaptive was sideways and down about minus 2.4% at this period. However, protected cut the drawdown by almost in half, which is a significant, basically, half the risk during this period of time. On the breakout in October during this trend here, which basically was from October through February 2020 before the crash began, total world was up 8, Ultra Growth, a new product of ours, up 15, Adaptive Growth up 11. Again, those are all net returns, not they do not include fees. And so it's a good way to measure. We use it for illustrative purposes only. Again, during this correction here, after fees, returns were Adaptive Ultra Growth minus 18, Adaptive Growth minus 14, while stocks as a whole using the total world were minus 35. So it gives you an example of how does it perform in cruise control markets and how does it perform in mountain driving markets. You can see that it has the ability to significantly reduce drawdowns, and during trends it can still capture returns. That's how we look at systems. We don't look at them January 1st to 12/31. We don't look at year to date. Those are important metrics because we understand why they exist, but we really look at what's the market environment, how much risk was taken, were we able to reduce risk, and how much return was there when the market was able to provide it. So from this period here, this sideways period, able to reduce the drawdown in half. During this period here, able to capture returns on the upside. We like that. More records in the second quarter. Basically one of the fastest rebounds we've ever seen. We had the fastest correction from a new high to a low ever. We had Bill Ackman, an expert, saying hell is coming. We, the economist, saying the world is closed. JP Morgan on April 6th says headed for a bad recession. We had newspaper headlines, worst unemployment since the Great Depression, the Great Reckoning from Time Magazine. Barron's is saying, hey, look at all these job losses we have and the dangerous gap between the market and the real economy talked about by the economist. We even had people like New York, a paper like New York Times saying the worst is yet to come at this point in time. We had Mark Cuban saying the market is overvalued. Buffett was saying we don't see anything attractive. Druckenmiller, a huge asset manager, hedge fund manager, says risk reward in stocks is worst he's ever seen. David Tepper says this is the second most overvalued stock market he's ever seen, behind only 1999, and that was in May. We've since continued to rebound, and the reason why it's hard to listen to experts and be on TV and listen to that is they can change their tune at any time. These headlines are within 60 minutes of each other after jobless claims are released. We've got stocks inch higher after jobless claims. We've got stocks fall as jobless claims remain elevated. So very interesting to see how the media will manipulate their headlines to influence you when we should be focused on price instead. And for our clients, instead of focusing on headlines, they get updates like this. We sent this update out in May, which gave a very clear indication of how we were going to game plan for the market, which was very, very simple, using something like the S&P 500. If we were above 2940, 2945, we're going to be involved with markets. If we were below 27 or 2800, we were not going to be involved with markets. That's how we think of things. If we have enough demand in the market outpacing supply, we're going to see price rises and we can be involved. If we're below important historical behavioral levels, we don't need to be involved. So we've seen the fastest recovery ever. So after a huge market crash, fastest ever, we've seen the fastest rebound ever. That's important to note. This chart here gives you an example of the depth or quickness of the correction, which surpasses the rest, and how quick the rebound has taken. Same thing when we look at the 40-day rate of change. This chart is from Bespoke. We can see we're in rarefied air as far as how quick we've returned, looking back 1928. Here's current period, how fast we've rebounded. How we rebounded off of the 09 bottom is here. We can look back to the 70s, even to the late 20s. We can just see how historic this is, where we are in a rate of change for a 40-day period. The significance of this is that when we look at index gains that have happened when we've rallied in a 50-day period more than 20%. It's short term. If I can put it this way, it's a short term negative, but a long term positive, right? Our 1 month and 3 month returns might be muted, but in the long run, our longer returns, 6 months, 12 months, are definitely positive. So that's a good thing when we see this, what we call a price thrust. When we look at another unique aspect of this rebound is that during this period from the bottom off of March 23rd, is that the majority of the gains have happened overnight. And so price moves have happened overnight. So we've gapped up in the morning, price might sell during the day. So if you had only bought during the day and then sold at the end of the day, you'd actually been close to negative during this period of time. You had to hold overnight to get any returns during this rebound. So now I'm going to take it over to this Q&A session with Paul, who's moderating, and Ian McMillan, our market analyst at Adaptiv. And we're going to go through some questions here. We enjoyed that Ian came in and joined us for this session. So I'm going to hand it over to Paul.
Thanks, David. I'm Paul Zarling, Managing Partner at Client First, and I'm going to host a question and answer panel with Ian McMillan and David Zarling. So welcome, guys. Good to see you. Good to have you. Ian, welcome. You're live and in person. You traveled up from Virginia with your family to experience Wisconsin this summer. How did the travels go with everything going on and with the little one?
I'd say for the first time with Connor on a plane that things went really well. No big embarrassing moments. He was a trooper. And to be honest, though, I need to credit my wife with 95% of that because she was the one that made everything happen. So yes, it went very smoothly. Happy to be here. Always nice to get to Wisconsin during the summers.
Perfect. Yeah, we love having you here, and we'll have you here again in the winters. We'll see how you're feeling about things. But hey, I noticed we have a couple extra slides that you kind of prepared. And for those viewing the video, can you walk us through the big picture environment that you're seeing and maybe some of the slides that you have prepared for us?
Yeah, I think Dave did a good job really covering the 30,000 foot view of what's been going on. And it's something that for those that have followed us for a while are pretty familiar with, taking something like an all world index that hasn't gone anywhere for 2.5 years. Or, I actually, to take a step back, I could argue a lot of these indices have gone a lot of places, yet nowhere. But looking 2.5 years, essentially a 0% return, and looking at other areas outside of essentially the S&P, emerging markets, small caps, industrials, all of these really, really lagging, all negative over the last year. I guess industrials are slightly positive, but again, outside of the S&P, not a lot going around. Really going back to those blow-off tops in January 2018. However, precious metals have been strong recently. Gold and silver, copper over the last couple weeks has been strong. So seeing some signs of what I guess one could call a potentially inflationary environment. We'll see where that goes. That's kind of been a boy who cries wolf scenario over the last few years. And then with, in the fixed income space, treasuries, corporates, aggregate bonds, munis, high yield, all in an uptrend since the March lows, and really in an uptrend for the most part. They were caught in the March sell-off, part of that throwing everything out with the kitchen sink, but have rebounded nicely, and yields continue to stay pretty low, relatively speaking. Speaking of yields, looking at just the income from, if you took something $1 million and had it in 10-year treasuries, just the vast difference we see now. 10-year treasuries only yielding 65 basis points. It's a far cry from where we were in back in the early 80s when you were getting, almost 11% on a 10-year treasury. Obviously, as we know, that has slowly dipped over the last 4 or 5 decades until, yes, where we sit now at just $6,500 of cash flows on a $1 million government backed investment. So certainly an interesting time if you are someone who depends on cash flow and that's kind of what your portfolio has been built around, or if you are going into retirement, kind of planning to build your portfolio around monthly or quarterly cash flows, kind of been a rude awakening.
Mhm. All right, thank you for those slides and thank you for the insight. I do want to come back to an uptrend question I have for you later in a minute, but I want to turn over to Dave here. For you, somebody could be drinking their coffee now, maybe they're drinking their lunch, maybe they've got a cocktail in front of them, thing time of day, but maybe if we could close the loop, how did your daughter end up?
Oh, Lydia, so that was middle of COVID. It was the end of April. Only one parent could go in the hospital, and so mom, being the nurse with her connections and knowledge, she was the one that went in with Lydia. And Lydia sent me a picture with her. Was her response to me just checking in on her, and then a picture of the granola bar with the notes. That was that evening, and how she hurt herself. Her and her older sister are frenemies, for lack of a better term. Sometimes they get along. Most of the time they get along. Sometimes they don't. And they like to mess around in our walk-in pantry. They like shove one in there, then they close the door and hold it shut. Well, Lydia kind of put her nose/face in the hinge or in between the door and the door frame, and the door got closed and it sliced her nose. And any good dad wants his daughter to get married, and so seeing that, a lot of prayers.
Right.
But she's doing great, so everything's good, and she's still got the great part about it.
Yeah, I'm glad she's all right, and you're right, prayers answered. She looks great now. It's something we can look back on and maybe chuckle at.
Yes, we can laugh now. Yeah,
birthday party or future wedding, whatever.
But
But I'm glad she's all right. Speaking of a slide that you prepared you prepared one. You have one here, which looks like the start of a marathon. So that question then kind of applies: is there a new bull market coming up? Is it not? With the financial media, kind of harping on bubbles and overvaluation, how do you think a new bull market?
Well, I think we're pretty evidence-based, so we focus a lot on price here when we're adaptively managing assets. And part of that process is also acknowledging when participation of stocks is full, there's lots of stocks participating, or when it's narrow. And so I like using the visualization of a marathon because, right, if you were sitting above a marathon, let's say like in a helicopter or hot air balloon, and you're watching this marathon unfold, right, at the beginning of a race, all the runners are together. It's at the end of the race where there's only a few runners.
Sure.
And that's what we tend to see at market tops, is we only see a few stocks lead. And some of the slides I have here are basically pointing out that we're seeing massive breadth moves that happen basically April, May, beginning of June, which a lot of these that I'm about to walk through basically have the premise of strong breadth, which in the near term, you might have some weakness, but in the long term, it's, like when the gun fires off in a race, you might have the initial thrust and then you start to have a separation. That seems to be the phase we're in now. But this first slide I have here is something from Macro Ops. It's a great chart, and it just shows 97% of stocks in S&P are above their 50-day moving average. The only time that type of breadth move has happened was in 1991. So that's a metric. It doesn't guarantee that we're going to have an accelerated bull market like the 90s. That's not what I'm saying, but the evidence is there for it, so our mind is open to it. The next slide is breakaway momentum. Walter Deemer, he's a legend in the business. He's one of the ones that studies momentum the most. This is basically just comparing advancing stocks in the New York Stock Exchange versus declining stocks. It's a ratio, and we've marked the chart with areas where this has happened in the past, and this tends to happen near market bottoms or the beginning of an accelerated move. It doesn't typically happen at tops. Again, not a guarantee, but we're open to the idea that because we saw this massive increase in breadth after capitulation selling in March, that we might be on the verge of a new bull market. Same thing, this next slide here, percentage of stocks that are trading at a 20-day high. So 68% of stocks were trading at a 20-day high, and they were doing this together. When you look at this chart, you can see that scenario in the past 10, 11 years is something that really only takes place during the beginning of an upward move. The next chart here is from Stratagas. This is talking about what we're seeing, if we want to talk about fundamentals, we don't really focus on fundamentals. Price is price, and that's going to dictate our process. But what we're seeing is that analysts at whether it's Goldman Sachs or Merrill Lynch or anything like that, and they're putting price targets on stocks, but stocks are trading well above that. Some people would be like, oh man, that means they're way overvalued. No, more often than not, I hate to say this, but analysts are wrong in that regard, setting price targets. Like Tesla's a perfect example where they're setting price targets that are well below where price is even at right now. So 61% of stocks are trading above their analyst target price. That's something we've seen off of the 2003 low and the 08-09 low. Now we're seeing it again. Final slide I have on here is RSI is a measure of momentum. It's a relative strength index. So for the last 30 years, when we look at how many stocks have that characteristic of being overbought, we're in a similar characteristic as we were back at the beginning of 90-91. So again, referencing back to the early 90s. Again, I'm not saying that's what has to happen, but many people are saying, oh, it's a bubble, or oh, things are overvalued. We're open to the idea that may be the case. We'll let price dictate that, but we're open to the idea that we could be at the beginning of a new bull run. We'll see.
Yeah, we'll see. We'll let price dictate that as well. So I want to turn to both of you with this next question, actually next two questions regarding, first one, risk, and the second one I'm going to have around volatility. All right, so first one is risk. COVID, protests, murder hornets, election, a lot to worry about. Are schools opening? Are they not opening? Are we have sports? We're not. Any insight you can provide regarding any as these relates to the market?
I'll take that one. I would say, again, if you've been following David and I for a while, we've made it pretty clear kind of our thoughts on how we feel about the media and scary headlines. So to us, obviously, this doesn't really play a major role in how we view the market or any day-to-day decisions that go into managing risk for our clients. And actually, to the contrary, I could say lots of these types of scary headlines, for lack of a better phrasing, think that they can actually many times help the market climb a wall of worry. So the worse the news, the more people seem befuddled that the market can keep going higher. And I wouldn't be surprised to see that continue on throughout 2020. It's certainly been a year with plenty in store for the newspapers and the tabloids and the media.
Like unemployment, right?
Yeah.
So.
Well, and I think that's a great example of the market started bottoming just as we started getting unemployment numbers, and I believe the first unemployment is released every Thursday morning, and for a good 4 or 5 weeks there, we would see, I believe the first number was 13 million, then 8, then 6. And so we were up to 25, 30 people unemployed in this country. And meanwhile, the market had rallied 30 to 40% off of that. And every Thursday, the market would just absolutely rip higher. You know, at 8:30 a.m. Eastern, this data comes out, and just gut-wrenching numbers from what one would think in economic sense, but the market just does not care.
Market's not the economy.
No, it is not.
All right, Dave, I'm going to turn to you for this one then. Seeing took the last one. We talked about volatility. You've talked about volatility earlier in the presentation, the records that we set, particularly look at the VIX, right? Late February is kind of in the teens. You know, by the middle of March, we're already in the 80s. That's a quick move. Right now, we're kind of, I don't know what the latest is, maybe around 25-ish or so. Ian's got it right in front of him. But talk about volatility, elaborate what you're seeing, and maybe some other potential implications for the market.
Well, I think you have to be open to multiple scenarios. Obviously, from an asset management standpoint, the lower the implied volatility, the more that is a characteristic for rising stock prices and easier to manage. You don't have these larger daily swings. However, as Ian and I have talked about in the past, there are market periods where you have elevated VIX and elevated prices. So you can have prices rise. Now, that's a difficult trend, if you want to call it that, meaning you still have overnight gap risk, on this move up, how many times have we seen it where we have a gap up during the day and they sell it in the morning and then they sell it off during the day?
Mm-hmm.
Then they gap it up the next day and then they sell it off during the day. So that is the trend we've seen since the bottom. There's part of me that wants to tell people that are listening that get used to it, meaning there are periods in these last years where volatility is high and stock prices rise.
Mm-hmm.
Now, the way we think about things, we don't just sit there and blindly say, oh, well, stock prices are just going to go up. We could see next week, VIX could be at 60 and S&P 500 is below 30.25, and we don't really have a strong need to be involved with stocks at that point.
Mm-hmm.
That's the way we think about it and manage risk. So for us, we're just going to continue to use price to manage risk regardless of what the VIX is doing.
Mm-hmm.
It's nicer when VIX is below 20. It feels better.
Smoother flight.
It's a smoother flight, right? That's a great. So the analogy would be, you can fly from the Midwest to Miami, Florida, and it could be the smoothest flight you've ever had. That's preferred. You could fly from the Midwest down to Miami and have tons of turbulence, but it still means the flight happened. You can still have trends with high volatility.
Mm-hmm.
Doesn't mean it's fun.
Right. I think the key takeaway is regardless of volatility, regardless of the worry, the wall of worry, the nice thing about you guys running the adaptive system is we're just going to be adaptive. We don't need an uptrend, we don't downtrend. We're going to manage based on price and based on what we need to do and the best interest of clients. So very excited about how that works, regardless of what happens. So here's the question that's been on everyone's mind, because unfortunately or fortunately, depending on your outlook, is we live in an increasing political and opinionated time. And so we have an election coming up in November. How is the election either going to or not going to affect?
To be honest, I have no idea if it will affect the markets or not. Obviously, it's something that's on everyone's mind. Both sides like to claim that when the market is going down or the market is going up, in an election year, that it's due to the market being scared of one candidate winning or being happy about another candidate losing, however you want to slice it up. The data says that no party really has a monopoly on stock market gains. It's pretty split down the middle. I'm not sure. Obviously, it's important to a lot of investment game plans out there, but not ours. So
Right. We know what we do know is that election years tend to be volatile
they are volatile
from
from
a
a seasonality
yeah.
standpoint.
And there is some statistical significance to the 3 months leading up to an election. Now, we only have the data set's small, but that's only because we've been around
But
since
then
the late
you've got a
1700s.
2016 where, we sold off really in October and November going into.
I think, we sold off in July, and then August, September, October, we actually rose. And so that was the 3 months leading in. And so that gave
I guess it was right.
I see what you're saying. You're saying that we sold off and that gave the challenging party the opportunity to win, which is what the data would show. Is that if you're selling off 3 months into the election.
Mm-hmm.
Because things got pretty nasty there
Yeah.
on the night of the election. Futures were down 700 points.
Yes, on the night of the election, the futures were down big time. What does it look like the 3 months prior? Curious.
We peaked in August.
And then sold off
And
into
then sold off. We peaked in August at 2,200, and then the night before the election, so we were down about 10%.
Right.
Going into the election night.
Okay, so that fits the data, right? That fits saying
Yeah.
the challenging party wins if the market is down 3 months leading, and the market can rise 3 months leading, and that can be good for the incumbent party. But that's not a prediction. I would say something like this too, that if Hillary Clinton had won the election in 2016, that we still might have seen the market rise. It might have just risen in different places. So I don't sit there, I don't sit here and just buy into the fact that if one person wins or another person wins, that's what happens with the market.
Well, and think of the people that have refused to participate in the last 3 years of gains in equities because of their political bias.
Right.
They went to cash on Wednesday,
Right.
November 8th,
Right.
2016, because
And
they refused to believe
and missed
that
2017, which was one of the greatest.
low volatile years
on
it's the
record.
least volatile year on record. While everyone would have pinned Trump's presidency, right? That was the narrative, that this first year is going to be just absolutely crazy. And I'm not saying it wasn't from a headline standpoint, but the market didn't care.
Right. I everybody was saying that if first they were saying Hillary had a 95% chance of winning, and then they were saying if Trump gets elected, the market's going to crash. The opposite happened.
And that's
In both scenarios,
Yeah.
the unexpected candidate won and the market rose significantly. And so you have to be open to all scenarios. I know we had a client ask in a live session about what does the market look like with a vaccine? Well, you're making the assumption that the market would rise if there was a vaccine. What if the market sold off if there was a
yeah.
vaccine?
What if we
Are you
talk
open to
about
that? Are you open to that
things
idea?
being priced in, and I go back and forth on how I feel about that saying that gets thrown around, but could be about the rumor in March, hoping that we were going to come out with a vaccine, and when we do, is it a sell the news type of scenario? I mean, there's no way to know.
Well, that's why we game plan, right? We've got different outcomes that could take place that we have to keep an open mind to. Like this current, when you look at the poll numbers, it's saying that the challenging party has a chance to win the election or is now favored. The media got it wrong last night or last time.
I don't know
are
why
they,
we're caught up on polls again
Right.
4 years later.
right. Like got it so wrong previously. Why do we care so much about them now? And if they're wrong now again, I mean, when are we gonna like carry the pitchforks and torches and carry the pollsters away and say like, what are you guys doing? Because you can't give us any good information. So for us, we're not gonna look at polls, not gonna look at CNN, not gonna look at Fox, just gonna focus on price. And if price rises after whoever's elected, great. If price falls after whoever gets elected, fine. We'll manage risk.
We'll protect.
All right, I want to come back to you on uptrends. I alluded to that earlier. What are you seeing in the back half of the year? Election aside, some pluses and minuses that you're keeping an eye out for.
Pluses, there's plenty of positives to go around. Copper, lumber, what I would call healthy rotation between growth and value in the different sectors in the market as we've kind of worked our way up, still being led by growth, which I think overall is pretty positive. We want to see large cap growth lead in things like technology and software. And to be honest, with not too many negatives, and then I think that is something that makes you kind of sit back and wonder why. And there's just a lot of really positive things lining up here with the world, a lot of people in this world acting as if we're this Armageddon. So it'll be interesting. I guess the easiest way to answer that is short term below 32.30, this most recent breakout, longer term below 3,000 or 31.25. 31.25, which was the October breakout level. So if we were back below there from a behavioral standpoint, I think that's would definitely be cause for concern.
You know, I think for me, just echoing kind of what you're talking about with seeing things like lumber and copper, which are in economically sensitive areas, perform well. It's interesting to see things like materials overall starting to show relative strength. And so while we like it that growth and tech are areas that are leading, seeing things like semiconductors lead is a healthy characteristic for the market. We could see a full rotation. Could be another period like 03 to 08. We get open to that idea, but for that to take place, materials would have to continue leadership.
Yeah.
You'd have to see leadership out of small caps and things
And
like
energy, yeah.
that. And that also was a period when gold and silver were doing well. So we're open to that idea, but right now, growth and tech remain in favor. And until that changes, that's where it will be tilted. As far as it does seem to be almost like this perfect mix of when you just look at price and turn off the news, lots of things are setting up very nicely. Once you add the news, it's even more perfect because everybody's scared of it. Everybody's either worried about COVID or politics or something like that. So it's this mix. So we'll see. Downside management, like you said, if we're below 30.25 in the S&P 500, it's a different story. You asked the same question back in January, I believe it was.
Yep.
And the market was not in a panic position at that point, start until end of February. But I remember us talking about it's really interesting that the Fed is injecting here. They were injecting a lot. No one was really some were talking about it within the industry, but it wasn't a retail. People didn't know that.
Sure.
And so that was a concern we had. Were they front running? Did they know something that we didn't know when it involved the panic? I don't know. So it is going to be interesting to see any type of liquidity response as we move forward if stocks continue to move higher. I'll say from a price perspective, there's plenty of positives that continue to move on.
Right.
All that gets thrown out the window if we can't hold the prior lows that we supported here at 30.25, 3,000 S&P 500, then that changes everything.
Right. It's interesting, right? You said you're seeing some growth and you want your best players to play well, and they are starting to play well. Like we're getting back to basketball, we're getting back to baseball. You want Giannis to play well, you want Christian Yelich to play well, and be in MLB respectively. So we have some of the big boys doing well. And like you mentioned earlier, when we had a conversation, semiconductors, trucking, copper, lumber, etc. But my last question is going to be on injecting funds. There's two kind of prevailing thoughts that are kind of duking it out right now. One is, hey, as soon as the money runs out, the plane ride stops, we got a glider in. Or the other side of that conversation is, hey, if they do it or don't do it, it's going to be rocket fuel, and we're going to take off for another round, right? Now, Steve and Jay may do another $1 trillion one. We don't know. That's at the time of this recording could happen. But I'd like to hear your comments on where we're at with injection in the market, the implications for that.
Yeah, I won't get too far out of my technical analysis realm, but unless you've got your own unlimited access to trillions of dollars to bet against the market, I don't think I'd do it. It's, as the old Wall Street adage goes, don't fight the Fed.
Yeah.
Whether you think it's fair or unfair about what they're doing, that is not real. I'm not here. I could care less whether it's fair or not. It is what it is. Markets are in an uptrend for now, so we will stay invested with that. If they were paying musical chairs and the music stops and it all comes crashing down, price obviously will be able to tell on the way. They could pull the plug and we could be just fine and the market keeps going. Or maybe they never. I mean, maybe we just buy high yield bonds forever till the end of time and the market never goes down again. That's a possibility.
Mm-hmm. I would just say Fed is nothing new.
Mm-hmm.
I think a lot of the Fed blame, meaning like people will blame the Fed for what the market is doing, really started after the great financial crisis and just got amplified after that. And like Ian, I don't have a flag to stake on, oh, I like what the Fed is doing or what the Fed isn't doing. I can only control what I can control. I don't get to dictate whether there is a Fed or isn't a Fed.
Mm-hmm.
Maybe some politicians do, and maybe our votes matter in that way. But all I'll say is the Fed's been around since 1913, same time the IRS started. So that's for listeners to go figure out on their own.
Right.
But I will say that, as Ian alluded to, we will see problems in the market shown through price. We said 30-25 on here how many different times in the stocks? If S&P is below 30-25, if you want to blame the Fed for that, go ahead. I don't care. The way I grew up, the way I played sports was you played the game and you didn't let the ref dictate your emotions. And so whether that's a good analogy or not, all I know is that when you play the game of football or you play the game of baseball, you don't let the referee or the umpire, whether you think it's fair or unfair, the call they made, dictate how you play the game. All you do is compete, and for us, competing means managing risk, being involved above certain price levels, and protecting below certain price levels. Like Ian said, I could care less. I know it's a great topic everybody likes to talk about. I appreciate that. But there's so much time wasted on talking about with the Fed, and it's not something you can control.
Are even correct on what they're going to do. You don't know what the domino effect, like what the ripple effect of that is.
Right.
People could say, oh, well, if they stop injecting money, people could take it as a sign of, well, now we're healthy enough that we don't need to be propped up by the government. So that must mean the economy's great and the market rips higher.
Right.
You never know how they're going to take it.
Right.
Mm-hmm.
Or what the narrative is going to be in the moment.
So it's just something we feel gets a lot of time, and understand why people are economists or whatever. But for us, we're going to take price over the Fed every time, and we'll manage that way. And the Fed can, Jay can worry about himself, and we'll worry about our clients and go about our day.
Yeah, makes a lot of sense. I want to thank you guys for taking some time out of your day to go through some questions that we had from others, and then also that we've heard kind of throughout the weeks. Appreciate what you guys are doing and piloting the adaptive flight, shall we say, as the pilot and co-pilot, along with Kevin helping out as well. And Dave, I'm going to turn over to you for some final thoughts on your presentation. And we'll catch up with everybody either at the next Lunch and Learn or throughout seeing you here in the office. You're somewhere across the state lines. I hope to see you guys soon. All right, take care.
Thank you, Paul and Ian, for joining me and doing that Q&A with me. I think that's really insightful for those listening. I just want to wrap it up with some final thoughts here as we wrap up the presentation and this video. As always, when we manage assets, for us and for our clients. We're going to use the Adaptiv System. We're going to be always identifying risk and reward. We're going to invest with the direction of the trend. We're going to manage risk using weight of evidence and position sizing. We're going to stay disciplined to the system and the hard data. And that's what's going to allow us to be adaptive to different market conditions. Swinging back to the thoughts that I shared with the story at the beginning, one of the things I wanted to touch base on is not only our adaptive investment management, but going back to the story of my daughter and how she had a difficult day. And I think you can all agree that those who are watching or listening, that we've had a difficult year. Whether it's some of the tragedies that have taken place in our society and the protests that have been a result, or whether it's COVID and the things that we're dealing with, whether it's the politics that are all around it, whether it's the fear to speak up or speak out, those types of things. We have the ability to respond. My daughter responded with one of her most difficult days by sharing something with me. I challenge you that are listening, turn off the TV, turn off the news. Don't focus on the fear. Take the disappointment, take those struggles that we're having in 2020 and reach out to someone else and do something well, do something for them that shows them love. And that's what I want to leave you guys with today is yes, we adapt, we want to manage adaptively, but I also want you guys focusing on others and not focused on the fear that you have going inside you, because 2020 can still end up being a great year and we can be better for it. Next month, we're going to have another education series in August. Justin's going to be leading us in tax case studies, tax strategy, and optimized tax preparation process. So sign up for that. You want to check that out for sure. If you want to do some true holistic planning with us, it's a 4-step easy process. You can schedule an initial consultation. There's no cost to you. You work with your client first team. They customize something, a true holistic plan for you, and then ongoing strategy meetings. And that way you can enjoy your new financial confidence. The way you go about that is you can dial this number here, 262-335-1700, or you can email us at myteam@clientfirsttaxandwealth.com. Otherwise, I really enjoyed you guys sticking with me on this presentation and this video. Check us out online at clientfirsttaxandwealth.com. Otherwise, we'll see you next time.